What if the day you retire is the exact day HMRC starts quietly taking money from you that you don't even know you're losing? Nobody warns you, no letter explains it. By the time most people notice, it's already too late to get it back without a fight. Before we go further, do one thing for me. Hit subscribe, not because I'm asking nicely, but because the next 8 minutes could be worth hundreds of pounds to you, and I post the kind of information HMRC would rather you didn't have. If even one of these 8 points applies to you, that subscribe button just paid for itself. Here's the truth nobody tells you when you stop working. For your whole career, your tax was handled by something running quietly in the background. Every month, your employer worked out what you owed, took it off your pay, and sent it to HMRC. You never had to think about it. It just happened. The moment you retire, that machine switches off. And here's the part that catches people out. Nobody switches on a replacement. HMRC doesn't send you a welcome pack for retirement. There's no checklist, no phone call, no friendly reminder. You're simply left to manage a system that used to manage itself, and most people don't realize this has happened until they get a tax bill, or worse, until they've lost money they were owed and never claimed back. I've spent years working close to this world, helping people untangle exactly these problems, sitting across the table from retirees who assumed HMRC was looking after them. It wasn't malice, it was just silence. The rules exist. The money is there if you ask for it. But HMRC will not chase you down to hand it over. You have to know what to do, and you have to do it yourself. So here are the 8 things HMRC genuinely expects you to handle the moment you retire. Most people miss every single one of them. Let's go through them properly, one by one. The first thing is simple, but it's the one almost everyone skips. Tell HMRC that you've actually stopped working. It sounds too obvious to matter, but it matters more than almost anything else on this list. Your tax code is built from information that flows in from your employer and your pension providers. The second you retire, that flow of information changes shape, and HMRC does not always catch up quickly. Sometimes it takes months. Here's the detail that catches people out completely. Your state pension counts as taxable income, but it's paid to you in full, with nothing taken off at source. So how does HMRC collect tax on it? By quietly adjusting the tax code on your other pension income behind the scenes. If that adjustment is wrong, one of 2 things happens. Either you overpay tax every single month for the rest of the year, money sitting with HMRC that should be sitting in your account, or you underpay without realizing it, and that gap turns into an unexpected tax bill the following summer. Neither outcome feels good, and both are entirely avoidable. So contact HMRC directly. You can do this by phone or through your online tax account, which we'll get to in a moment. When you speak to them, say something like this: I've recently retired, and I want to make sure my tax code correctly reflects all of my pension income, so I'm not overpaying or underpaying. That single sentence tells the person on the other end that you understand exactly what's going on, and it usually triggers a proper review of your tax code rather than a quick, surface-level fix. One small but important note: if you live in Scotland, your tax code will start with the letter S, something like S1257L. The system works the same way, but the tax bands and rates are different, so it's worth knowing that distinction exists. The second thing on this list is the tool that makes everything else on this list dramatically easier. Set up your personal tax account online. It's completely free, it takes about 10 minutes, and once it's running, it becomes your control center for every single thing HMRC does with your money. You'll need your national insurance number, a recent payslip, or your P60, and either a passport or a driving license to get set up. Once you're in, this is where you check your current tax code, see your state pension forecast, review your full national insurance record, and read any letters HMRC has sent you, even ones that never physically reached your letterbox. And here's a small detail that trips up more people than you'd expect. If you moved house around the time you retired, this is also where you update your address. It takes 30 seconds, skip it, and important letters end up going to your old address, where they sit ignored or get thrown away by whoever lives there now. If you do nothing else after watching this video, set up this account. Everything else becomes easier once it exists. The third thing is one that genuinely shocks people the first time they hear it. Your state pension does not arrive automatically. Read that again, because it's the single biggest false assumption I come across. People imagine that once they hit state pension age, the money simply starts landing in their account, the way wages used to. It doesn't work that way. You have to actively claim it. About 4 months before you reach state pension age, the Department for Work and Pensions sends you an invitation letter with a code on it. If you ignore that letter or it never arrives, your pension doesn't get paid. It simply defers. Now, deferring can sometimes be a smart, deliberate choice if you're still working and don't need the money yet. But it should be a decision you make on purpose, not something that happens to you by accident. Right now, the full new state pension works out to a little over £12,500 a year, paid weekly. To get the full amount, you need 35 qualifying years of national insurance contributions or credits. 10 years is the bare minimum just to qualify for anything at all. State pension age is currently sitting around 67 and shifting gradually over time, so don't assume the age you remember from years ago still applies to you. When that letter arrives, you can claim online using the code it contains. Or if no letter shows up and you're within 3 months of reaching state pension age, you can phone the pension service directly and sort it that way. Your first payment usually lands within about 5 weeks of claiming. Let me tell you about a man I'll call Tom. He reached state pension age and simply waited, assuming the payments would start showing up on their own. 6 months passed. Nothing arrived. He hadn't actually lost any money. The payment was backdated once he finally claimed. But in the meantime, he'd built his entire monthly budget around income that was never coming. And he spent half a year stressed, confused, and quietly anxious every time he checked his bank balance. Don't be Tom. Claim it the moment you're eligible. Now we get to the point where HMRC's silence genuinely starts costing people real money, sometimes thousands of pounds. This is the fourth thing, and it's about what happens the first time you take money out of a private or workplace pension flexibly. When you make that first withdrawal, your pension provider almost never has your correct up-to-date tax code yet, so instead, they're forced to apply something called an emergency tax code on what's known as a month-one basis. Here's what that actually means in plain English. The system assumes that the amount you withdrew is what you'll withdraw every single month for the rest of the year, and it taxes you as if you're about to receive 12 times that amount annually. Picture someone taking out £10,000 from their pension as a one-off withdrawal with no other income that month. Under the emergency code, the system behaves as though they're about to earn well over £100,000 a year and taxes them accordingly. In practice, that can mean somewhere around £2,800 gets taken straight off that £10,000 withdrawal. The actual tax owed, once you account for personal allowances properly, is often close to nothing. That means thousands of pounds sitting with HMRC that should be sitting with you. This isn't a rare glitch. It happens constantly, every single week, to ordinary people who simply didn't know it was coming. The good news is the fix is straightforward, once you know it exists. There are 3 different claim forms depending on your situation. One if you've taken part of your pension and plan to take more later in the year. Another if you've emptied the pot completely and have no other income. And a third if you've emptied the pot but still have other taxable income, like your state pension. All 3 can be submitted through your personal tax account, and HMRC's stated turnaround time is around 30 days. To give you a sense of just how widespread this is, HMRC repaid well over £40 million to more than 13,000 pensioners in just a single 3-month period recently. And that figure only includes the people who actually knew to ask for it back. Plenty more simply never claimed. That covers the basics, the foundation everyone needs to get right. Now let's move into the 4 things HMRC genuinely doesn't advertise, the ones that quietly slip past almost every retiree I've ever come across. Most people retiring today know about their personal allowance, the chunk of income, just over £12,500, that they can earn each year completely tax-free. Far fewer know there are 2 additional allowances that stack right on top of it. And almost nobody realizes that, structured correctly, you could have over £18,000 of income a year without paying a single penny of tax on it. Here's how the layers actually build. The first layer is your personal allowance. The second layer is something called the starting rate for savings, which lets up to £5,000 of savings interest be taxed at 0%. But here's the catch. HMRC never highlights that £5,000 allowance shrinks pound for every pound of other income you have above your personal allowance. So once your pension and other non-savings income crosses roughly £17,500, that starting rate allowance has effectively disappeared. The third layer is the personal savings allowance itself, worth £1,000 if you're a basic rate taxpayer, £500 if you're a higher rate taxpayer, and nothing at all if you're in the additional rate band. Stack all 3 together for someone on a modest income, and you land at roughly £18,500 of completely tax-free income. Let me give you a real picture of how this plays out. Imagine a retired woman, no workplace pension, living on a state pension of around £11,000 a year because of a small gap in her national insurance record years ago. She also has £15,000 sitting in a savings account earning 4% interest, which works out to £600 a year. Add it together, and her total income is around £11,600. Her tax bill? 0. Her personal allowance covers the pension entirely, and the starting rate plus the personal savings allowance comfortably cover the interest, with thousands of pounds of headroom left over. This matters far more now than it did a few years ago. Interest rates have stayed elevated for an extended period, which means ordinary cash savings are now quietly generating enough interest to drag people into a tax position they never expected. And here's the part that genuinely frustrates me. HMRC often estimates your savings interest using last year's figures. So if you were briefly pulled into a higher tax bracket because of interest 2 years ago, when rates were higher, and you've since moved that money into an ISA, your tax code might still be punishing you for income you no longer even have. If that sounds like your situation, call HMRC and say this clearly. My savings interest is now within my personal savings allowance and starting rate for savings. Please remove the savings income adjustment from my tax code for the current year. That sentence does exactly what it needs to. And one quick clarification. Money inside an ISA doesn't count towards any of these allowances at all. It's separate and it stays tax-free no matter what. If this is genuinely useful to you, this is exactly the kind of thing worth sharing with a parent, a neighbor, or a friend who's just retired. Send it to them now before you forget, because this is precisely the information that quietly saves people money. Now, let's talk about the one that genuinely frustrates me every time I think about it. Marriage allowance. If one partner earns under the personal allowance threshold and the other is a basic rate taxpayer, earning under roughly £50,000, the lower earning partner can transfer a portion of their unused personal allowance, currently around £1,260, across to their spouse. That reduces the higher earner's tax bill by up to around £250 every single year. This allowance has existed for over a decade, and you can backdate a claim by up to 4 tax years. That means a couple claiming for the first time today could recover well over £1,000 in backdated payments, plus the ongoing saving going forward. HMRC's own figures suggest millions of eligible couples have simply never claimed it. Millions. The data already exists inside HMRC's own systems. They know who's married, they know who earns what, they know exactly who qualifies. The system could simply write to people and offer it automatically. It doesn't. You have to be the one to ask. The application is free and handled directly through the government's official website. It must be made by the lower earning partner, not the higher earner, which is honestly the most common reason claims get rejected or delayed. You'll need both national insurance numbers, and if you're backdating, you'll fill out a separate paper form for previous years. One important warning here: avoid the third-party companies that show up at the top of search results offering to claim this for you. They typically take 30 to 50% of your refund for something that takes 10 minutes to do yourself, completely free, directly through HMRC. The next thing on this list is short, but I want you to listen carefully, because getting this wrong can genuinely cost you money you'll never see again. If you owe tax that can't be collected automatically through your pension income, HMRC sends you something called a simple assessment letter. Roughly 140,000 pensioners receive one of these every single year, usually because their state pension has crept above the personal allowance threshold. The system is supposed to make life easier, and in fairness, most of the time it does. But here's the honest reality. The figures HMRC uses are frequently estimates, particularly around savings interest. They often rely on last year's numbers, or a general summary from your bank that doesn't always specify which account earned what. You have 60 days from the date printed on the letter to dispute it if something looks wrong, not 60 days from when you opened it. From the date on the letter itself. If it sits unopened in a pile of post for a few weeks while you're busy or away, you've already burned through half your window without realizing it. Once those 60 days pass, your right to challenge the figure disappears completely. You end up paying whatever HMRC calculated, accurate or not. So when one of these letters arrives, open it that same day. Cross-check every figure against your P60, your pension statements, and your bank's annual interest summary. Payment is typically due by the end of January following the tax year, or 3 months from the letter date if it arrived later in the year. Most of the time, the figure HMRC calculates is correct. But often enough, it's wrong by a meaningful amount. Always check it yourself. And now we reach the final point, the one I genuinely want you to share with the people you love most, because it affects not just you, but everyone you eventually leave money to. From April 2027, unused defined contribution pensions will be pulled into your estate for inheritance tax purposes. This brings an end to a rule that's been in place since 2015. For the last decade, financial advisors have routinely told people to spend their other savings first and leave their pension untouched for as long as possible, specifically because pensions sat outside inheritance tax entirely. From April 2027 onward, that long-standing advice flips completely. The government's own projections suggest this change will affect roughly 8% of estates and bring in well over £1 billion a year in additional tax revenue within a few years of being introduced. If your retirement plan was built around the old rule, it's worth taking another look at it now while you still have time to adjust. There is one important exemption that was added later. Pension assets passing directly to a surviving spouse or civil partner remain exempt from this change. Children and other beneficiaries do not get the same protection. Around the broader rules, your nil rate band currently sits at £325,000 per person, and it's frozen for several more years. If your home passes to a direct descendant, there's an additional residence allowance worth up to £175,000 per person. Put together, a married couple with a family home could potentially pass on up to £1 million before inheritance tax applies at all. Above that threshold, the rate is 40%, or a slightly reduced rate if a meaningful portion of the estate goes to charity. There are also gifting allowances worth knowing and actually using while you're alive. You can gift up to £3,000 a year tax-free, and if you didn't use the previous year's allowance, you can carry it forward once. You can give up to £250 to as many different people as you like. There are larger one-off allowances for weddings depending on the relationship, and perhaps most powerful of all, regular gifts made out of your normal income. Money you genuinely don't need to live on can be completely exempt from inheritance tax as long as they don't affect your standard of living and form a clear, consistent pattern over time. If you're someone drawing more pension income than you actually spend each month, this is a conversation worth having properly with a qualified advisor. And I want to be honest with you here. None of what I've shared replaces proper, regulated financial advice. For a real conversation about estate planning specific to your situation, speak to a regulated independent financial advisor. And if you have a defined contribution pension and haven't used it yet, book a free appointment with the government-backed pension guidance service designed specifically for people over 50. It costs nothing, and it's genuinely useful. If you've made it this far, you've just absorbed more practical retirement knowledge than most people pick up in years of muddling through on their own. So before we wrap up, do one more thing. Drop a comment telling me which of these 8 points surprised you the most. I read every single one, and it helps me know exactly what to cover next. Here's what ties all 8 of these together, and it's worth sitting with for a moment. None of it happens automatically. HMRC doesn't write to remind you about marriage allowance. The pension service doesn't call to nudge you toward claiming your state pension. Your pension provider won't volunteer the fact that they're about to apply an emergency tax code to your very first withdrawal. The entire system runs on what you ask for, not on what you're rightfully owed. So here's your honest checklist. Tell HMRC the moment you stop working. Set up your personal tax account today, not next month. Actively claim your state pension when the time comes. Reclaim any emergency tax taken from your first pension withdrawal. Understand and use your full stack of tax-free allowances. Claim marriage allowance if you're eligible, and go back the full 4 years while you're at it. Read every simple assessment letter the day it arrives, not the day you get around to it. And start thinking seriously about the inheritance tax changes coming in 2027, while there's still time to plan around them properly. None of this needs to be done in a single afternoon. Pick the one that applies most directly to your situation right now, and start there. Most of these take nothing more than a single phone call or a 15-minute online form. That's genuinely all it takes to stop money quietly slipping away from you. For years, the system handled all of this in the background without you ever needing to lift a finger. That era is over the moment you retire. Now it's on you. The rules are fair, the money is real, and it's sitting there waiting for the people who know to ask for it. HMRC was never going to call and tell you. Now you know. Take care of yourself, and take care of the people you love enough to share this with.